Hey investors, Bradley here from Watson Estates. Thank you for joining us on Toronto's #1 real estate podcast. Today we're going to highlight what could be a big issue in the next few months. We're talking the big six banks preparing for defaults when mortgage deferrals come due. Now, you might know that the banks have been kind of allowing people to defer their mortgage, and this is causing a little bit of a problem. It's shaking things up, if you will, in the banking sector. And I want to talk about what's going on there, what they're doing to prepare for it, but then go a little bit deeper and talk about the financial stability of the banks and when all this stuff would roll out and how it could affect our local Toronto real estate prices. Now, before I get started, my name is Bradley. If you haven't already jumped into following our daily podcast, we put out great content every single day. So make sure you check that out. And we try and give in these videos, which we do alongside our daily podcast, we try and give you guys some more insight, some further details. And today I want to highlight this whole segment because I think the tricky thing is going to be not so much where we've come from, but in the future, because we're seeing a lot of strength now in our marketplace, if there is any additional shock or correction that could happen. And this is one area where CMHC and the big banks are kind of bracing for impact. So let's look at some of these articles here. So one of them is called Canada's Big Six Banks Set Aside Over $10 billion for Bad Loans, up over 300%. We actually did a morning podcast under the same name. Now, what's happened here is the Canadian banks have actually reported their Q2 earnings this week. So we've seen them all kind of dripping these financial statements, and a common theme among all the reports is this increase, a huge increase in a thing called PCLs, the provisions for credit losses. So what this is essentially debts considered unrecoverable. The way that they describe it they're found in financial reports. It's a dollar value deducted from income equal to the amount anticipated in loan losses. So in other words, it's money they're not expecting to see. And it really is an accounting term that we don't hear all that much, but it's becoming more and more public these days because that number has shot through the roof. And as you can see, some of the big banks, so we can see it's led specifically by TD, but the biggest jump happened by RBC. They were up 564% from last year. BMO follows with an increase of 530% year over year. Now, to contrast, Scotiabank we see on the lower end at 111, but even still, to have a 100% increase from last year is still noteworthy, is still newsworthy, and I actually think Scotiabank was one of the first ones to come out even before, as we were kind of anticipating more from these banks. So this is something we should be paying attention to because what happens when all of a sudden those deferrals you've been allowed to accumulate with your lender is all of a sudden not allowed anymore. And they start saying, hey, now you need to pay. Well, the first thing that you're going to expect to see, generally, experts agree, happens in the non-mortgage credit section first before missing mortgage payments. So to miss a mortgage payment is a big deal. So people start pretty much having delinquencies outside the mortgage before it applies into the mortgage. So that's step one. Now, rising delinquencies are expected across all segments, and this is according to TransUnion. They've kind of laid out different scenarios. In their moderate scenario, they see non-mortgage delinquencies rise to just under 7%. But what they're kind of saying is from what we've seen and the numbers that they're tracking, they actually tend to think it's closer in line with their severe scenario, which would mean hitting above 7.5% delinquencies on these non-mortgage credits. That's step one. Step two is, well, what happens if this translates into the Canadian mortgage delinquencies? And they're saying that they're expecting it to rise, listen to this, 200%. In the severe scenario. By Q3 2020, they expect that the originations to drop by 43%, this is new mortgages, by 43%, the average balances to rise by 20% as people stop aggressively paying off balances, right? So we actually haven't seen a lot of bankruptcies and foreclosures. These things aren't really happening because of the ability to defer. Well, what happens when the deferrals run out? The delinquency rate, they say, could rise 200%. So when would this happen, if at all? Well, they're anticipating that the payment holidays, when it all originally started, was expected for 6 months. So what our timing, if this is going to kick in, if this is going to cause a problem in our local Toronto real estate market, would be at the end of the third quarter 2020. And we would, if we saw a surge for mortgage deferrals begin, ideally, in the ideal world, the economy will be back on track by the fall, and most clients will be able to meet their payment obligations. People get their jobs, the unemployment numbers will start to come back, or at least open up for some new careers, if not your previous one. But if not, if in fact we see that there's kind of a second drop in prices, as we've seen kind of what happened in 2008, which is kind of like a rebound from this accelerating prices that follow the drop. If a drop happens again, then maybe there will be another buying opportunity for some of you investors out there. Before we talk about that, I want to highlight, I found an article on the Motley Fool, and they highlight TD. Now, TD is the one that has the highest PCLs. And in the quarter, they were among number one. They had 3.2 billion in PCLs. Now, the question is are they in trouble? So we dig into this article and they say that the number does not necessarily mean that TD actually lost this money. An important thing to note about PCLs is that it's more of an indicator. It's more of like an estimate and assumption. We're not going to collect this, but it doesn't mean they can't collect it. It just means they've pretty much written it off. Now, when we look at the financial stability of TD, they reported adjusted earnings of 1.6 billion for the 3 months ended April 30th. So their revenue was actually up compared to the same time last year. It was up. TD has one of the best dividend growth track records in the TSX index over the past 2 decades. And the stock, which traded at 49 per share in March, is now up to 63. That's a 5% growth during that time. Pretty good. And when we look at their mortgage segment, we see that uninsured property loans represented 71% of their portfolio. Now, that loan to value rate on that segment is 54%. So here's the thing. In theory, this means the housing market would have to plunge significantly before TD would be forced to sell foreclosed properties at an amount lower than the value of the loans. So this 2008, dumping these properties for a song and not worrying about recuperating losses, the value of these homes need to go down substantially. We're talking 54% is the loan to value, a huge drop. The banks will do everything they can to avoid taking the keys back from homeowners. Defaults will occur given the scope of the economic crisis, but the number will hopefully be small. And this is where people stand divided. Will this be a big problem or maybe just a little bit of a hiccup? Time will tell. But one of the things that I'm thinking about is if the banks won't dump the property unless we experience severe price declines, then how can they be the catalyst for extreme price declines, right? If they're going to be acting in response to price declines, then that won't be what kind of triggers it, at least not in my mind. It doesn't sound like banks will be what starts a tailspin, but they will be there to make the problem worse if a tailspin already happens. The question is where would that start? Now that's left to you guys to make the decision. My takeaway for you today is that the banks are fine. They are prepared. In fact, they're preparing for delinquencies even in their financial statements. But the bad news is that they are expecting a lot of people won't be able to pay their bills by Q3 2020. The best thing in the event that prices do come down for you as an investor to position yourself is to have cash. That's what the big investors are doing that we are interviewing on our podcast, on Toronto's #1 real estate podcast. And if you have money to swing it in another deal, tends to come back in the fall later this year, maybe that's your opportunity to get involved in the greatest market, in my opinion, in the entire world. I'll see you guys next time. Take care and keep it real.